Thank you for joining us today. As we approach the latter part of the first quarter and an uptick in debtor and possession transactions, we decided as a team that a prudent topic for our quarterly webinar today would be today's market landscape and DIP financing. Joining us today from the LSQ team is Tom Favola, our Director of Underwriting, and Doug Golden, our General Counsel. My name is Renee Jackson, and I lead the sales team here at LSQ. Prior to handing the floor over to Tom and Doug, I thought I'd give you a brief overview of who we are and what we do here at LSQ. LSQ is based in Orlando, Florida, and was founded 25 years ago by a gentleman by the name of Max LSQ. Currently, we're one of the largest privately held working capital finance companies here in the U.S. Within our national footprint, we have funded over $25 billion to small to medium-sized businesses. Over the past 25 years, we formalized over 40 bank partnerships in an effort to act as an incubation tool, primarily by bridging the gap to companies in a transition period and/or high growth mode, allowing for them to return to a bankable status. During today's webinar, Tom will be reviewing the current market landscape, bankruptcy trends, and will discuss some of our recently funded DIP transactions. Tom has been in the industry for over 25 years and has a wide array and experience in this sector. Doug Golden, prior to representing LSQ, spent numerous years in commercial litigation, bankruptcy, insolvency, and the reorganization space. Doug will speak to his experience and the events that may occur and disrupt projections. At the end of the presentation, we welcome you to ask questions by using the webinar control panel to submit, and feel free to ask questions at any time. With that said, I will hand it over to you, Tom.
Thank you, Renee. Welcome, everyone. My name is Tom Favola. I'm the Director of Underwriting here at LSQ Funding. We thought it would be good to start off the webinar by level setting and taking a look back at 2020 as it relates to bankruptcy filings. The first graphical representation that we have here represents the total U.S. bankruptcy filings in 2020. And you'll note right away that there was a significant downtick in total filings across all chapters in 2020 compared year over year to 2019 by approximately 35%. That firstly is the lowest that it's ever been in the last 35 years as far as measurement of bankruptcy statistics go, and a little bit surprising, I think, on two levels. As I think back to about 12 lifetimes ago at the end of 2019, myself and some internal peers as well as some external peers were opining about what we thought might happen in this very space in 2020. And the general consensus I recall at the time was that there was an expectation that bankruptcies as a whole were going to rise in 2020. Wasn't sure exactly when. There were a lot of driving factors for that, but one of the primary factors at the time was the amount of US debt on corporate balance sheets. It was at that time the highest it had ever been, and there was a prevailing consensus that at some point throughout 2020, the piper needed to be paid, and there was going to be some atonement for this amount of balance sheet debt that was being carried. It had been sort of increasing year over year for the past several years, and that's actually indicated here in the graph. If you take a look at 2015 to 2019, you see a downward trend before that of decreasing bankruptcies and then a leveling off. That's because corporate debt to some extent was increasing, and there were other options besides filing of bankruptcy for a lot of organizations. So we're going to take a look at some of those things that drove that today, as well as provide some projections. If we take a closer look at bankruptcy filings, specifically as it relates to our next graphical image, Chapter 11 filings in the US for 2020, an interesting part is that while total bankruptcies were down across all chapters, Chapter 11 commercial filings were up by approximately 29%, which is, I think, pretty material. Interestingly enough, that this cohort of the total bankruptcies was up and indicates a little bit of what I was just talking about, or at least I think so, that two factors played a large role in 2020 of driving these commercial bankruptcies up. One was the debt that was already being carried in, and the pandemic being a very specific event that also by itself could have likely caused some increase in Chapter 11 filings. And that's what we want to focus on today. We're here to focus specifically on what we believe is going to happen with Chapter 11 commercial U.S. filings, and that's what the bulk of our presentation represents. So as we start to think ahead for 2021, and we believe we can project what's going to happen over the course of the year as it relates to Chapter 11 filings, our projections for 2021 are as follows. We believe there's going to be a notable increase in Chapter 11 filings. There's a lot of reasons for that. We're only going to address a few of them here that I think might be a little bit more interesting to talk through. But overall, we believe Chapter 11 filings are going to notably increase prior to the end of 2021. Same prediction that was in 2020, and hopefully we're not wrong 3 times in a row. One of the things that is certainly going to increase filings across 2021 is going to be the completion of PPP 2.0. We're right now currently in the midst of issuing PPP to a lot of small businesses 2.0, and if there's any indication of how it operated the first time, at some point within the next 60 to 180 days, we would expect this to end. And when that ends, there's going to be choices that need to be made by several organizations. And so we believe that's going to create an environment where there's going to be the opportunity for significant more filings. The other thing that is probably well known is, currently in institutions and banks, there's a lot of forbearance and moratoriums that have been issued and continually are extended. Well, at some point, these are going to stop as well. As there is more certainty in what the marketplace is going to shape up to look like, and there be a little bit firmer projections, it's likely going to expose the fact that there's going to be several institutions that are going to stop the continuation of these moratoriums and these forbearances that they're issuing currently to a lot of their portfolios. And that will certainly create an environment whereby Chapter 11 is likely to be a more viable option for several of these organizations. Something that might not be as mainstream, that may not be thought about, is increased personal or consumer filings. Right now, very similar to PPP 2.0, there's been a lot of government stimulus to consumers, and that's certainly propping up several families and or households as unemployment is at a much higher level than it was pre-pandemic. And so at some point, that's just not sustainable to continue. And we believe that there are going to be increased personal filings in 2021. Well, with that, over the course of time, it's pretty consistent that commercial filings follow in tandem with an increase of personal filings. And with that, given that we've already seen that commercial filings were up in 2020, an additional increase in personal filings are likely to pull those commercial filings even higher. And lastly, something else that is not as mainstream today, usually talked about, is Subchapter 5. And what Subchapter 5 is a specific subchapter to the U.S. Bankruptcy Code. It was enacted back in February of 2020, and its purpose and design was to allow smaller businesses to be able to file Chapter 11 with more ease and the ability to move through the process a little quicker. The original intent was in lieu of Chapter 7, and this is an area that Doug Golden, LSQ's General Counsel, is going to focus on specifically a little later on in our presentation. But needless to say, as Subchapter 5 grows in both popularity and knowledge increase because it's a newer program, we believe this will also promote an additional wave of Chapter 11 filings throughout 2021. It could probably go either way, but I'm coming down on the side that this is going to help promote that. Now, speaking of the wave for 2021, waves come in all different sizes. Not really sure if this is a 2-foot wave or a 22-foot wave, but certainly believe that prior to year end, we're going to see a notable increase in Chapter 11s. If we break 2021 down into a smaller tranche and we just focus on the next 90 days, the prediction here is generally that we're probably going to remain in a status quo environment. What does that mean? Perhaps some elevated filings. However, mostly it's probably going to continue along with the a wait and see type approach. As I was doing a lot of research regarding Chapter 11 and just bankruptcy filings in general, I was reading not that long ago, maybe 2-3 weeks, the end of February, some information put out by Epic, which, by the way, for anyone who isn't aware, Epic is a first-class resource for bankruptcy information in the United States. If you're ever looking for additional information, that's as good of a place as any to go to find statistical information. If there's any folks from Epic on the line, that was your unsolicited free plug. But as I was reading, there was a specific article as it related to the projection of Chapter 11 commercial filings in 2021. And Deidre O'Connor, who is the Senior Managing Director of Corporate Restructuring at Epic, in direct response to that question said, "We appear to be suspended in an air bubble at the moment." And I think that's a fabulous representation of what is going on currently. That as it relates to Chapter 11 bankruptcy filings, we are suspended in an air bubble. One of the reasons for that is because there continues to be uncertainty in the marketplace, or uncertainty in general. And as long as there's uncertainty, that breeds hesitation. And when there's hesitation, there's the wait and see. And that's what drives some of the elements that we see that's allowing organizations to have other alternatives other than Chapter 11 filings. One of the other reasons why we expect it to remain status quo, again, the inversion of what I was just talking about. While we expect before the end of 2021 Chapter 11 filings to increase as a whole, over the next quarter, we project them to remain flat or generally performing the way they have been performing the last few months. A large reason for that is PPP 2.0, in the process of distributing it now, and that's going to provide these companies an extra 60, 90, 180 days worth of lifeline to where they won't have to look for an alternative solution. They can use these funds to continue to operate their business. Also at the institutional level, forbearance and covenants are expected, forgiveness is expected to continue through Q2. And why wouldn't it? While there's other options for a lot of organizations through PPP and perhaps even some other alternative options, why wouldn't they continue? In 2020, we saw the largest reserve, loan loss reserves by US banks for at least the last decade, if not more. And so they're likely well positioned to be able to, when the time comes, to be able to absorb some of these losses. But if they're able to trade space for time in the interim, some of these firms might be able to pull themselves out of the trouble that they're into by using PPP and maybe some return later on to normalcy, and might actually lessen their losses. But as long as there's an outlet, it makes sense that some of these institutions, for a variety of reasons, outside of the scope of this webinar, but reputational risk is certainly something that I've heard quite a bit of as to why these forbearances and covenant forgiveness is in the first place, but they're going to likely continue on at least through the next quarter. Something that's a little bit more anecdotal and much less documented is business owner resiliency. There's at least been some information, as businesses that have made it this far through the pandemic continue to fight and struggle to survive. Small business owners have always had the label of being resilient and being, tough operators generally as a whole, and the backbone of, a lot of the economy. But, for example, I spoke with two local business owners, both restaurant owners in the past few weeks. And one of them, I had two very interesting that I think takeaways came from. The first part was, he firmly believed that we're nearer the end than we are the beginning. And the fact that he's been able to fight his way through this long, there's no reason to give up now when there's light at the end of the tunnel. So I think that, That certainly can't be the only business owner that might be thinking that way. And I think that's going to continue to maintain the status quo as some of these folks continue to fight on. And the second element to that was the the ability that he believes that there's also some help behind it, and that there's going to be continued help while we navigate through whatever this is till we get to the natural end of it. So when you combine those four, again, lots of other factors to help maintain the status quo, but when you combine those with the other factors, we believe that it's going to stay generally flat, and we're likely not to see any type of a material increase or even necessarily decrease over the next quarter. Some disruptors to these projections, and on this particular slide that you're viewing now, we're going to break it down into two segments. The bottom left is a table which shows a couple of elements that might disrupt both to increase or accelerate filings or decrease or decelerate filings, and then a graph on the right, which we'll visit at the end after I've walked through the table in the bottom left. So a couple of items that I think are worth note here to talk about that might disrupt these types of projections are especially in the increase or accelerant side is, first thing you have to look at, I think, is sector or industry performance. There were a number of industries that were in trouble pre-pandemic, retail, energy as it relates to oil and gas, that were already struggling when the pandemic hit. And then there were several industries that were hit quite hard just directly from the pandemic. Restaurants, entertainment industry, real estate, for example, are some of these. I've also included healthcare. That's going to be more of a 2021 focus, and I'll touch on that in a moment. But there's a lot of fissures in these current industries right now due to the trouble they were experiencing pre-pandemic and the stress that has been added with the pandemic. If these industries cannot hold out for whatever time is required to emerge on the other side, to provide a little bit more certainty on who is going to fail and who might succeed, these can create a very significant tailwind for Chapter 11 filings. If these industries start to crumble at a much faster pace than anticipated, it can really increase the amount of filings that we'll see. Something else that will provide an accelerant to Chapter 11 filings, we believe, is an increase in interest rates. I mentioned earlier that one of the reasons why Chapter 11 or commercial filings were down in the first place, because the large amount of corporate debt that was being carried pre-pandemic. The pandemic has just served to push that to even further acute levels. If there's an increase in interest rates, that's going to push some of these companies who are, some companies are termed as zombie companies today. Zombie company being a company that has a greater interest expense than their current revenue stream, to shorten it down in a single sentence. But if these interest rates increase, that's certainly going to push some of these entities over the edge. They're not going to be able to, they're already struggling to service it. It's going to create even additional struggles for not only the current lenders to these organizations, but the organizations themselves, and can really serve to increase the amount of filings that you might see. Again, many other factors that can increase or accelerate Chapter 11 filings, but these two seem noteworthy to me and of interest to discuss in more detail here today. From a decrease or decelerating aspect, the first thing that might serve to help suppress or keep down some of the filings is access to capital, both in the market or whether it come from the market or come from the U.S. government itself. I mean, the fact of the matter is, here we are, we're issuing PPP 2.0. There could be a PPP 3.0 or 4.0, depending on the length of time that this pandemic is considered to continue. Also, and that will certainly continue to suppress filings. Something else is that, let's think for a moment if institutions actually start to clean up their balance sheets a little bit and say, hey, we've got reserves, let's start transitioning some of these tougher transactions out. Well, if the market is ready, willing, and able to absorb these transactions, whether it be from an alternative lending perspective or there be some froth in the M&A market, there's going to be better choices than filing Chapter 11 or filing for the protection of bankruptcy, because they can again kick the can down the road further with another source. And so that will serve to certainly decrease the amount of filings. Again, something more along the lines of a little bit more anecdotal is out of court solutions. It's certainly not undocumented totally that there's been organizations that have settled some of their challenges out of court, where they could have used the protection of bankruptcy, but they decided to work it out. And that probably happens more at the very smaller business level, where there aren't as many creditors and more local businesses, I would imagine, than there be national type businesses. But certainly that can serve to help reduce the amount of filings. And the fact of the matter is that throughout the pandemic, from the start even up to now, businesses have been shuttering. These are smaller businesses where they just simply stopped operating. And if and when the time comes to come back to some sense of normalcy, what might happen with some of these businesses? They may never even file. They may just cease to exist, and matters are taken into some creditors' hands, and they go and take care of what they need to take care of. So this can also serve to decrease the amount of filings as well. Something that can work in either direction is going to be I think the U.S. vaccination program. So if the efficacy of the vaccine or the efficiency in which it is distributed is done very well, that's likely to increase the amount of filings, because what that will probably do is create some level of certainty in the market, which means then that there's going to be the ability for more solid projections to be made, and there be a sort of tally system as to which firms may or may not make it based on whatever the new normal is, or return to the old normal, or something in between. And so with that, I believe it will increase the amount of filings, because certainty will then show whether or not companies can survive. However, if there is not very wide adoption of the vaccine as intended, or there's a botched, something occurs with the rollout that delays it to some significant amount of time, then we talk about that uncertainty again. And when there's uncertainty, that's where it's likely to slow down, because then other factors or forces might step in place to fill the void of the uncertainty in the interim, similar to institutions implementing forbearance, government issuing stimulus to both consumers and to businesses, and so forth. So that's something that can go either way, and we're in the process of seeing how that's going to work right now. I think the jury's still out on that. Okay, let's go back to the sector performance. If you take a look at the graph on the right side of the slide, what you'll notice is in 2020, some of those industries and sectors that I mentioned initially, that if they continue to slide at an increased pace, can really accelerate the amount of filings. But it's noticeable here when you just look at some of these. For example, there's 300 to 400% increases in some of these industries in the filing 2020 versus 2019 year over year. Entertainment is one, up by several hundred percentage points. Oil and gas, 300% increase there. Not necessarily unexpected. The pandemic certainly pushed a lot of those over the top. They were already struggling to begin with. And so would expect that these be the leading industries in 2021 as well, that are likely going to lead the charge for commercial filings. One that I mentioned earlier, healthcare, you don't see here for 2020. Healthcare also was in trouble in 2020 as it started due to rising costs, lower reimbursements. There was even talent issues, a lack of talent to be spread around to a lot of locations. And the government really stepped in and helped some of these facilities and a lot of these healthcare organizations survive out of necessity, especially during the pandemic, with their ability to pump some stimulus into these. Well, in 2021, there's some sense of normalcy that comes about this. These these weaknesses that were present going into 2020 will resurface in 2021, and there'll have to be some tough decisions made. Facilities are going to really have to figure out how they're going to continue to survive, or do they seek the protection of bankruptcy in Chapter 11. Okay, so with that, what I'm going to do next, we're going to move to the Subchapter 5 element analysis of our part of the presentation, and Doug Golden, LSQ's General Counsel, will explain to us why it's an important program and some of the observations we can make with it. So with that, Doug, I turn it over to you.
Well, thanks, Tom, and thanks, everyone. There's lots happening right now in real time with Subchapter 5. It's an exciting time. I'm excited to share the key information with you today. So Subchapter 5 of Chapter 11 went into effect in February of 2020. And the goal primarily was to decrease costs for debtors and create more opportunities for small businesses to seek Chapter 11 relief. There was a lot of changes to Subchapter 5, but some of the key highlights include that fact that there is no unsecured creditors committee unless one is appointed by the court, and there's no U.S. trustees fees paid by the debtor. That saves a lot of money for potential businesses looking to do a Subchapter 5, particularly not having to worry about the unsecured creditors committee and paying for those attorneys. Additionally, there's no requirement for the debtor to file a disclosure statement. Again, something that's very laborious and a time-consuming process. It eliminates the absolute priority rule, so owners now can retain their equity in the business over the objection of a claim of unsecured creditors without having to pay those creditors in full. So it gives more options to successfully emerge from Chapter 11. And there's shortened time frames to file and complete a plan. So a plan or reorganization must now be filed within 90 days of the commencement of the case. So all really good changes, saves a lot of money. I think potentially it's, all great opportunities. Almost immediately after Subchapter 5 went into effect, COVID hit. And as a result of all the stay-at-home orders, Congress passed the CARES Act. And the CARES Act, in addition to creating the Payment Protection Program and providing additional financial assistance for businesses and individuals, also amended Subchapter 5 by increasing the eligible debt limit for debtors from $2.7 million to $7.5 million. So now businesses that have up to $7.5 million in debt can look at and potentially file a Subchapter 5 plan, which is great. Unfortunately, the increase in the eligible debt of a Subchapter 5 debtor has a sunset provision, and at which time the debt limit will revert back to $2.7 million, and that happens in a couple of weeks on March 27th. It remains at this point to be seen whether or not it will be extended. That being said, a couple of weeks ago, on February 25th, a Democrat and a Republican senator introduced the COVID-19 Bankruptcy Relief Extension Act. It's a bipartisan legislation to temporarily extend COVID-19 bankruptcy relief provisions enacted in the CARES Act. And as it relates to Subchapter 5, the bill would extend the maximum debt limit of $7.5 million for another year. I think this is really promising because it has bipartisan support, which we have not really been seeing very much of in Congress lately. And it also has the support of the American Bankruptcy Institute, or the ABI, which is the largest association of bankruptcy professionals. In fact, last week on March 5th, the ABI sent a letter to the senators who introduced this bipartisan legislation and raised some, I think, great points. The first being that nearly 30% of all Subchapter 5 cases are filed by debtors whose debt exceed the original $2.7 million debt limit. And according to the Executive Office of the United States Trustees, cases filed under Subchapter 5 are experiencing higher plan confirmation rates, speedier plan confirmation, more consensual plans, and improved cost effectiveness than in those cases if those cases had been filed in Chapter 11. So as a result of the increased debt limit, more small businesses are being successfully reorganized during the pandemic. So I think that's a good thing, and hopefully Congress will do its job, do the right thing, and keep the debt limit of $7.5 million in place for the next year. Moving to the next slide. So the issue of PPP loan eligibility for bankrupt businesses, the courts are currently split on this issue as to whether the government can deny PPP assistance to bankrupt debtors. Back in December, when Congress passed an additional round of COVID relief legislation, the issue was addressed, but it was not really resolved. The new legislation allows, but it doesn't require, and that's key, debtors in possession and trustees to obtain PPP funds, but it's subject to the SBA's determination that the debtor is otherwise eligible for the loan. So Congress has in effect gave the SBA, who is the administrator of the program, the ultimate power to decide whether to approve PPP funds to companies currently in bankruptcy. On the most recent PPP borrow application form, which was updated last week on March 3rd, it inquires whether the business and its owners are currently in bankruptcy. If you check yes, then the form states that the loan will not be approved. So it appears the SBA plans to deny PPP loans to bankrupt debtors, despite the fact that Congress has expressly allowed businesses in bankruptcy to receive PPP funds. I think we're going to see more litigation on this issue in the coming months. As I said, the courts are currently split, but I am also cautiously optimistic that the SBA may come around on this issue and hopefully resolve that ongoing litigation. In terms of the numbers of Subchapter 5 and the possible effect that COVID-19 is having on Subchapter 5, there's been 1,595 Subchapter 5 elections as of March 4th, 2021, according to the American Bankruptcy Institute. And the top 5 states for Subchapter 5 cases are Florida, Texas, California, New York, and Illinois. So sort of what you'd expect. Small business debtors, I think, need to be aware that as it relates to the amount of debt that they've incurred, again, the sunset provision that reverts the debt limit from $7.5 million down to $2.7 million is coming up on March 27th, unless, of course, it's extended. So maybe we see a short uptick of Subchapter 5 filings in the coming weeks. But hopefully that debt limit is increased. And additionally, I think small business debtors should be cautious about PPP loans because although they have forgiveness provisions, the terms, may be confusing. And if the funds are not, if the funds are not utilized according to the program, they may not be forgiven. And if that happens, it's definitely possible, once the PPP funds are dry up, we may see more of a surge of bankruptcy at that point. But once that happens, if the PPP funds are not forgiven, then that would affect what the total debt, that could affect as a decision to file, and of course what the debt limitation is of a Subchapter 5 at that point, and whether it's 2.7 or 7.5. If it's 2.7 at that point, that could force a lot of businesses into a traditional Chapter 11 bankruptcy or liquidation. So we'll have to see what happens there. And the graph on this slide is also from information from the ABI. You can see that the amount of filings for Subchapter 5 have been pretty steady over the past year. So we'll have to see again what happens with the debt limit, if that goes down, and hopefully as more people catch on as to the benefits of Subchapter 5, we'll see more filings. And with that, I'll turn it back to Tom.
Thank you, Doug. Okay, for the final portion of our presentation, we're going to spend a few minutes on a couple of DIP, debtor in possession transactions that we've been a party directly to and that we've done. We've selected 2 case studies today. Our first case study involves a 98-year-old catalog printer firm in the upper Midwest, about 100 million in annual revenue to give an idea of the size. And in mid 2020, the company elected to file for Chapter 11 bankruptcy protection. What ultimately drove them there was that at the end of 2019, they had projected significant growth across their customer base for 2020. And so they went out and purchased a fairly sizable amount of M&E and some additional real estate to gear up for this anticipated growth. Of course, pandemic hits at the end of Q1 2020. Company is unable to service its debt, and LSQ was asked by their current senior lender, which was at the time a regional commercial bank, to partner up with them to navigate through the Chapter 11 process. The bank didn't want to take full exposure. One of the reasons why was because LSQ was involved and engaged. By the time we actually funded, it was August of 2020, but they were entering into their very busy season. You can imagine a catalog printer, the holiday season is very big. A lot of their client base was in the retail sector, some light industrial. And so the bank didn't want to continue that exposure. We structured something with the bank. We were able to do it very rapidly. I think we negotiated the structure within 4 or 5 business days of being contacted. Took a little longer than that, obviously, with all the parties to come to agreement on the structure. And by the time that the company was ready to petition the court, we had a united front with current lender, us LSQ being the lion's share lender for working capital on a day-to-day basis. And we were able to show up with a solution ready for the court. So that was the business case made for this, and I'll hand it over to Doug very quickly, who will talk about some of the legal solutions that we put in place.
Yeah, so on this case, it was a situation where because we were, retained and able to negotiate with the pre-petition lender ahead of time, it was really great because everyone was sort of able to get on the same page, and you can't, predict every possibility of what's going to happen in a bankruptcy, but being able to work, if the DIP factor is different than the pre-petition lender, being able to work ahead of time and get on the same page and get the debtor on the same page really is helpful and streamlines the case. The difficulty in terms of the negotiation was basically determining who would get what between the pre-petition lender and the DIP financing company, LSQ, in a catastrophic event. And, luckily in that case, we were able to come up with a really creative solution that made everyone feel, comfortable enough to proceed. Additionally, just in terms of the DIP financing order that was entered with the court, we were able to agree that there would be an escrow that would be put in place in which the administrative claimants, the attorneys' fees, the attorneys, the accountants, the turnaround folks would all be able to obtain their fees from that escrow account, and that escrow account was tied to the DIP budget, and that would be the funds and the only funds that the administrative claimants would look to for their fees. And having that tied to the budget and just getting that resolved on the front end really, I think, just made everyone work together in a way that was really productive because there was no surprises. And I think the professionals were able to budget their time accordingly. And, in a bankruptcy situation, there's just the biggest problem is just not always enough money for everyone to go around, and getting that resolved on the front end, I think was really helpful. Additionally, we put in benchmarks or milestones in the DIP order as far as deadlines that the debtor had to meet. That helped move the case along as well. I think that was a really beneficial thing that was done. And we tried to have releases, everything that we could negotiate on the front end in the order we put in. And again, it went, very smoothly. One little hiccup in that case was a landlord that was contesting where one lease was assigned and one lease was rejected. And, they made the argument that they were cross defaulted and they both need to be assumed. Again, you can't anticipate every aspect of a bankruptcy, but that would be, one thing I would recommend for anyone that's considering providing DIP financing or filing for bankruptcy is just have a due diligence checklist to make sure that the debtor has some, feasible plan to deal with any angry landlords and creative arguments that they could make.
Thanks, Doug. So the outcome on this one, again, we LSQ funded in August of 2020. The company emerged after about 6 months in Chapter 11 through the completion of a successful 363 sale, and they're currently they exited us, and the pre-petition lender Newco was able to recapitalize and refinance the facility, and since then they've been operating successfully for the last several months through 2021, and likely to continue on. Moving along to our second case and final case study. This was a 35-year-old solar panel and roofing business. The draw here was that a lot of their contracts were with major and national building companies. They also did some residential work. This was about an $85 million a year annual revenue company. From a business perspective, the solution that we were able to provide, we came in and we were the we came in actually after they filed Chapter 11. So they had filed Chapter 11. Current senior secured lender had sufficient amount of fatigue. Gauged LSQ. We came in, funded in July of 2020. We were the sole working capital provider. And we were able to structure a solution that provided working capital to emerge this company from Chapter 11 throughout the remainder of its case. One of the interesting facts here was, we knew they had strong contracts with national builders. Obviously, national builders are a little skeptical with firms that are in Chapter 11. Are they or aren't they going to emerge? So one of our business challenges was, as these contracts were being serviced, it was dependent upon the type of work that was being thrown our clients' way from these national builders. And that significantly created variable costs in the amounts of payroll based on the number of employees they had working. Would go up, it would go down over a week-to-week basis. Obviously, their insurance costs would also go up and down. And one of the most important needs was their material needs to be able to, complete the installation of these solar panels and or roofs. And so we were able to structure a unique solution and show our flexibility by changing our advance rate, sometimes even over advancing past our comfort zone, but based on the underlying credit, we felt comfortable doing that. And LSQ today continues as a large portion after they've emerged from Chapter 11, as we continue to provide a source of financing for them in a fairly sizable amount. Doug, you want to touch on the legal side here?
Sure. From the legal perspective, the issue really on this particular case was coming into the bankruptcy after it had already been filed, which, as in case study 1, it was great that we could negotiate ahead of time. With case study 2, we didn't have that luxury. It's not to say that you can't do it this way, but it does present different challenges, I think. One of the bigger issues that I saw was by the time LSQ came into the bankruptcy, and after negotiating with the senior secured lender, pre-petition lender, we had to deal with a significant amount of vendors in this case, since this was a construction bankruptcy. And through the bankruptcy, a critical vendor motion was entered, which allowed certain vendors to receive payments on pre-petition transactions in order to complete those deals and move forward within the Chapter 11 debtor in possession. So when LSQ came in, there was a significant amount of negotiating and horse trading and creative solutions that we had to look into in terms of how to make the critical vendor order work alongside a debtor in possession order, where funds were ultimately being sent to LSQ, but we were able to fund those critical vendors pursuant to the critical vendor order. So through some creative negotiations and concepts, we were able to ultimately get that to the finish line. And then in this particular bankruptcy, there was a 363 sale, and we were able to work and negotiate with the buyer for that bankruptcy sale. So it was another layer of complexity, another new party that came in, but ultimately we were able to assign and assume our facility to the buyer in the 363 sale, who since now emerged from bankruptcy.
Thanks, Doug. So the final outcome on this one, again, LSQ funded in July 2020. After about 8 months, they emerged from Chapter 11. And as I mentioned, we continue to play a large role in their continued financing on the other side with NewCo. And so with that, that concludes our case studies, and I will turn it over to Renee, who I believe has some closing remarks, and we move into our Q&A session.
Wonderful. Thank you, Tom and Doug. So as you mentioned, we'll open it up at this time for Q&A. We already have a few questions in the queue. Looks like, Tom, I think this one is for you. Will LSQ fund post-dip facility? Will they fund the post-dip facility as well?
The answer to that is yes. LSQ has the capability and ability to fund during the debtor in possession financing period as it navigates its way through Chapter 11, as well as continuing on post-funding as the need is there.
Excellent, thank you. Second question is just coming in here. How fast does it typically take to structure and finalize a DIP facility?
That's probably a question for both Doug and I. I'll answer from the business perspective. Usually it's pretty quick. We can usually assess a transaction and propose a structure within a matter of a couple of days once we're able to get the information that we need. I think the trickier part is finding the capital structure, the financing structure is probably the easy part. There's usually a lot of parties involved from my experience in Chapter 11 DIP transactions, and I think that plays a direct role, and I'll let Doug speak here, but from the legal perspective, that can certainly allow some time for negotiations depending on the number of parties.
I think that's right, Tom. I would just add that usually in my experience, by the time the DIP lender is brought in, hopefully it's before the bankruptcy has been filed. But usually it just seems like time is of the essence, like the debtor is sort of up against the wall and things need to move rather quickly. So I normally tend to see like an all hands on deck situation, and usually, if it works out and it's going to happen, it gets pushed through and negotiated rather quickly.
Great, thanks, Doug and Tom. So one last question here. I think, Doug, this question is for you. What are the biggest red flags that a DIP funder considers before seeking court approval to fund?
I think in addition to to make sure that the collateral is good, but assuming the lender is comfortable with the collateral, I think being able to work with the pre-petition lender is key, because it's just a lot of time and expense to move forward and seek DIP financing if all parties aren't on board. So if a resolution, global resolution, cannot be reached between the debtor, the pre-petition lender, and the DIP factor or the DIP lender, I think that it's probably going to be tough and expensive and potentially not something that you'd want to get yourself into.
Thanks, Doug. So I'm just looking here. Any more questions in the queue? We'll give it a moment here, and then we'll wrap up. We just had another question come in. This is for you, Doug. How much legal expense is involved in an LSQ DIP facility?
I think it also depends. If you're able to negotiate on the front end, it's significantly cheaper. And depending if there's in-house counsel involvement or if you're solely relying on outside counsel. But the fees can certainly add up quickly. Another reason why, if you're able to negotiate or try to foresee any possible issues that may arise in the bankruptcy on the front end, it just saves so much time and so much attorney's fees in fighting those issues when you could try to resolve them on the front end and you don't end up in a bankruptcy case that's just languishing with all the attorneys fighting, and that's kind of when fees really rack up.
Absolutely agree. Thank you so much. So I think those are all of the questions that we have. Just wanted to thank everyone again for joining our team today. We also will be sending out a recording of the webinar within the next 48 hours. So look for that in the queue. And with that said, we appreciate everyone for joining and have a wonderful day. Thanks so much.